Okay, very good morning, Thursday 24th of May. Just to give you an overview, going to talk about FOMC, Trump, Turkey, Brexit, and then a very heavy speaker slate to come. I'll try and get through that as quickly as possible, and then we'll hand over to Sam and he'll talk about the charts as usual from a technical perspective. But having a look at the market moves this morning, it's been a little bit difficult, I think, coming in to try and judge the next kind of market move, really, in terms from a sentiment perspective, because we've had really quite seesaw battle between the kind of bulls and bears here for a market sentiment basis. By this, what I mean is that yesterday, obviously, equities under a bit of pressure, seems to be a bit of a return back to renewed trade confrontation, predominantly from the US. But then last night, what came out was the FOMC minutes, and they were overall perceived erring slightly on the dovish side, so equities then rallied. Then overnight, Asia took a kind of more negative interpretation, brushed aside the FOMC minutes, and was more focused on the kind of deterioration of the return back to Trump kind of reigniting this trade conflict, particularly on the area of car imports now, and then also with this North Korean breakdown ahead of the summit, which was scheduled for June. However, then Europe's come in and equities have started rallying again. So I would say, even for me, trying to read through all of the material and just listening to some of the pundits this morning on Bloomberg TV and reading the research, I prefer in this type of situation to just kind of sit back, let the market show its hand, and rather than try to force a view on what I think the next kind of direction or move is going to be, because to be quite frank with you, I don't know at this point. Looking at the S&P here, we're having a push up to retest close proximity now toward the initial high that we printed just before the close on Wall Street, which obviously came in the aftermath of the minutes last night, just looking in the center right here at the S&P. In the currency markets, the dollar's a little bit softer, down about 0.2%. Quite commonly what we see is that whenever there is a kind of more of a protectionist stance from the US, which we've had occurred from some of the news from overnight, that typically does weaken the dollar. So it has seen euro dollar here just move back above its pivot, and cable's just sitting quite tight, up about 20 pips around its pivot, and we'll have a look at some of the associated stories there. So let's have a run through of the news then, and a couple things to be aware of. And starting off with this, so the FOMC minutes, again, just going to very broadly brush over the main points, and the initial interpretation was one of being slightly on the dovish side. If we just run through some of the key points here that Reuters have picked out of the actual minutes themselves, all Fed policymakers expected 12-month inflation to rise in the coming months. So it definitely, at this point, we are on course to continue on the rate hiking cycle. Obviously the question here is how many, whether or not it's going to be 4 for this year, or currently the projected 3, with the rate hike still anticipated priced in the 90s for the next June move. So we're still looking for an interest rate hike only in the next couple of weeks. Going through the other comments though will probably make a bit more sense why the market took a slightly dovish interpretation. Policymakers noted the widely expected increase would not be in itself justify a change in projected rate path. Strong majority of policymakers view prospects of retaliatory trade actions by other countries as a downside risk to the US economy. All policymakers agreed US economic outlook has strengthened in recent months, and almost all policymakers supported a hike at March meeting, so the previous, and a couple pointed to possible benefits of postponing a hike, actually. So if you're looking at kind of, I guess this one, the one about economic growth continues to improve, inflation continues to rise in the coming months, so this all justifying then the economic general improvement to warrant further rate hikes, but a little bit of caution coming out of the others, the downside risks from the trade side, and also, even when they did hike, there was still a couple who pointed to possible benefits of postponing. So a bit of division between the FOMC. Okay, so that was that. Looking at Trump, to give you an insight to what's going on here. Obviously, you thought, given where we were at the beginning of the week, this kind of conciliatory tone issued from the Treasury Secretary, Stephen Mnuchin, very short-lived. Basically, Trump's trade policies returning to the forefront. The president ordered the Commerce Department to consider a probe on auto imports for national security purposes under a specific section in their legislation. While there's also noted that tariffs as much as 25% are being considered, and is likely an attempt, according to some people's view, to prod NAFTA counterparts for a better deal. Don't forget, NAFTA is also still ongoing in the background as well. And certainly this comes alongside increasing uncertainty on whether the US and North Korean summit will go ahead, just given what appears to be a bit of a breakdown on both sides at the moment. Now, what does this mean for car makers in particular? Well, just having a look at this, actually I've seen a better chart than this. This was the DAX breakdown, but if I go to the fast FT, they've just put a decent graphic up I've just seen flash down, so here it is. European car makers down a gear as Trump cranks up tariff risk. So you can see here the market open and subsequently all the major of what is a large collective representation of the DAX index, the car makers, BMW, VW, Daimler, Porsche, all seeing quite a significant drop. BMW the most sharply, down about 5% on the back of this. Don't forget, obviously the US is a particularly big area for those German exports. So that definitely has soured some of the market sentiment, but as I say, coming in, it looks like markets in Europe have largely brushed that aside. If you look at the DAX future this morning, it has found a bit of support around that afternoon price area. We tested that this morning and we've bounced all the way back up since that point to pretty much see a gap fill in the futures and toward that 13,000 level. A few other things then, just to be aware of. Turkey, this has obviously been a bit of a focal point of late, and if I just bring into screenshot the Turkish lira, give you a bit of an idea of what's exactly been going on here. So this is a broader picture of the charts. So this is dollar Turkish lira, and really this is the beginning. If I put a marker down here to the beginning of the month, and so really going through the course of May, we've seen real substantial weakening, almost going from 4 to 5 in dollar lira. And then what's happened here in the last week has been broader market focus, I think, on the emerging market currencies inspired by this ongoing weakness in their local currency. That's kind of caused then a lot more focus, and so the move has got more violent as more participants and speculative traders came in. And then that area there, if I drop it down to this time frame, this was from what we've been seeing more recently, and this being then the intervention tactics that have been ongoing. So a couple of things to be aware of here is the Turkish central bank, after putting it off, really under the command of Erdogan for such a long period of time, a number of weeks, they have now raised interest rates at an emergency meeting, bowing to pressure obviously on the run on their currency. So they raised their liquidity window rate by 300 basis points to 16.5%. And this of course comes ahead of what is politically timing is a speech coming out as new elections get underway and Erdogan wants to run again. And the whole point was here, he was very reluctant to do so because he's referred to previously as interest rates being the mother of all evil. But he's had to kind of give in, I guess, at this point, just given the significant impact it was having on their currency and consequently their economy as a net result. So for now, you could say we've had, due to that move, a little bit of reassurance that the central bank is now active in that market to protect the currency. However, as you can see here, more recently, then people are very, well, there's still the question mark on how this is going to play out in the long run, because already some of that move has been taken back, so we'll see. The other thing, of course, and just to really go over what happened yesterday, Italy is Premier designate starts quest for government support. So obviously Conte has been given the role now to try to form the government and come to meet political party leaders after accepting that mandate. How has that played out in the markets? Well, obviously people had thought that Conte going through to this stage we're at now might have been a net negative, because it brings the prospect of these kind of far-reaching, more populist proposals which don't really deal with the bigger debt issue in Italy very well. However, yesterday we did see a bit of a recovery actually. What you're looking at here is BTP futures, so the Italian bond market. And obviously you can see here, so if this was inverse, yields have been rising quite sharply and dramatically over the last 2 weeks or so as this situation has kind of come to the boil. But here we've had a bit of stabilization, a bit more of consolidation around the 132 mark here, but I think certainly this is something to keep a half an eye on as we continue to go forward. Elsewhere, just want to have a quick look at the pound, because lo and behold, the transition talks are now talking about 2023. So forget your 6-month extension, forget your 12-month extension. It's now looking like Theresa May will ask the European Union for a second Brexit transition period to run until 2023 to avoid a hard border in Ireland. So, you know, I hate to say it, but this was always going to be the case. It's so incredibly complex, this Brexit situation on the trade front, specifically the issue of Northern Ireland. I just think that this was inevitable. I was talking about this in the strategy report on Monday, which is why I think actually I just question how much further downside are we going to get in the pound. Now, granted, I think there is still some room for that, but ultimately I just think that this Brexit story is just going to be such a slow burner, because legally it's so complicated, and we're kind of seeing that come to reality with a lot of these reports. So the question mark is, and what could prompt that more near-term negative move would be if you have a political breakdown, because if Theresa May starts saying to the people who voted by majority, well, okay, slightly from a democratic process, to leave, you're now telling them that actually we're not going to leave, we're going to continue to stay pretty much status quo all the way from 2016 through to 2023. You know, are people going to be satisfied with that, even from the public's point of view, from the political point of view, from the Brexiteers? The other thing, of course, which they've been talking about this morning is the cost. Now, obviously, you've got to, you know, this is the FT, and you know they have a certain angle that they certainly do report on Brexit, but you can't get away from the actual statistics. And that is that businesses will face extra bureaucracy, costing up to 20 billion a year if Britain opts for the max-fac customs deal with the EU favoured by Brexiteers. So in basic terms, the extra form filling on the kind of border issue facing British and foreign companies as they cross their proposed streamlined, this is, customs border, it's going to cost about 17 to 20 billion pounds. That's almost twice the size of Britain's net annual contribution to the EU budget in the first place. So I definitely feel politically, I think this is going to intensify over the coming weeks, I'm sure. And obviously the big question more longer term over the coming months is, can Theresa May see this out to the end? I think Sam was looking the odds on the bookies now. I think it was 6 to 1 in the end of the year was earlier this week. It's probably something similar like that. We'll see. But longer term, I do think that this Brexit situation can only be prolonged, and the longer that is, I actually think that the more net positive that starts to become for the pound, because it removes the kind of urgent and fear factor of something dramatic happening on that regard. Okay, moving on. Let's have a quick look at the calendar. We've already had a couple of data points. You've had German GDP for Q1. No real surprises there. It came in at 0.3% quarter on quarter, so bang in line with expectations. The one that obviously any sterling traders need to focus on today, you've got UK retail sales. So obviously these types of figures surrounding the consumer are always quite meaningful for an assessment of where we're at with Bank of England monetary policy, which has taken a decidedly dovish turn of late. We, as a service-based industry, would need this type of figures and the consumer to remain, positive in their spending behaviour. So that does definitely need to be watched. We are looking for a bit of a bounce from the previous depressed figures. I guess this might be to do with the bounce back after the poor weather in the previous month. Other things to look out for: ECB publishes its minutes. Now, this is not often that market moving, but I think certainly just warrants some attention, and I think it's worth listening out for later, so do be aware of that. It's at 12:30. The US session, Thursday, so weekly jobless claims. You also get things like existing home sales, but pretty quiet actually on the economic data front for the US. Actually, probably what I'm more interested in hearing from is, do we get anything more from Donald Trump on Twitter? So definitely keep your wits about you, I guess, from around 11 a.m. London time. That's when Donald tends to wake up and start firing away on his Twitter account. And obviously the main thing to be looking out for is the latest proposals about the probe on auto imports and also the Korean situation. The main thing that I want to draw your attention to for the day's calendar is the speaker's schedule. Check that out. It's one of the most busiest ones I've seen in quite a while. So 100% you cannot put a trade on, specifically for the internal traders who are still relatively new. You should not put a trade on unless you're fully aware in that strategy of the risks associated as a person speaking at that specific point in time. What I mean is, don't be stepping into a pound trade when you know Mark Carney's just about to speak. The risk is heightened that he might say something new, and that needs to be factored into how valid is the strategy that you're making in terms of the timing. So definitely get a printout of this calendar and be absolutely mindful of the timings around these particular speakers coming out. So to give you a bit of a flavour, you've pretty much got representation from all three major central banks. So you've got Federal Reserve members, you've got ECB members, and then you've got Mark Carney speaking a couple of times as well. Now, Mark Carney speaking just shortly. He's giving welcoming remarks, so I would say it's probably unlikely he's going to say anything too new there. But he does speak in a Bloomberg interview later on this evening for those in the live trading room if you're trading later on tonight. All right, I'm going to leave it at that. Hand you over to Sam. So I'll see you in the chat room. And I wish you a good day ahead. Thank you.
Hi guys, good morning. So yeah, obviously got Carney speaking in shortly, just around 9 o'clock scheduled, and then the data at 9:30. So we'll come on to pound in a minute. Just catching my attention here. S&P, yesterday's high, Tuesday sort of morning, afternoon low, just being hit there as an area of resistance. So quite a key point for the market today. Whether that will hold for the morning or not, we'll have to wait and see. There's also the FTSE's just hit the pivot, which was yesterday's sort of morning low as well. So equity's just finding a bit of resistance up where we are now. To the downside, I'd say pivot. You're really now looking at the low of the day for equities. R1 looks quite good as another key level. Before that, I would have marked up Tuesday's evening's high if we were to get push on. Equities have been tricky. You can see obviously after gapping up this week, we're now pretty much where we would have come into the office on Monday morning as well. So overall direction pretty tricky, pretty range bound really for the last sort of couple of weeks. That key point of Tuesday's high, weekly high, and the high that we also had back on the 14th, and R1 perhaps later on we get tested, would be pretty important, I think, going forward. And that's going to be the same obviously for the other equities over in the US. Looking at Euro, had a bit of a push above the pivot, and it's sustained that. The classic working okay. Obviously the dollar recently has been pretty strong still, so I still favour overall the downside. It might well be, again though, you're looking for this market just to come a bit higher when to commit to the short. I think R1 looks good. You've had the break of that trend that we saw yesterday morning. Not a bad area for your sort of stop loss as well. If you look here using the high of yesterday morning, sort of the lows of Tuesday afternoon, decent area I think in the market that could attract some sellers. Before that, obviously, we'd have to get quite high up to get to that point. We had resistance at these levels yesterday where we pretty much had the high of today, and then obviously before that you had the breakdown, and then S1's yesterday's resistance as well before to get to that. But of course, you know, if you were to take the R1 trade on, those could well be the targets that you're looking at. Nothing wrong obviously if your bias is to the upside. You know, I saw a couple of people did go long on the pivot and booked some of that profit, so that's good. Looking at yesterday's low, today's low, we saw this a couple of times last week when you had coming in the morning and perhaps looking for dollar strength later in the day, having this sort of this trend on here. And if you do get the break on through, then you can start to target previous lows and the 117 handle, of course, for the futures as well. So maybe you're looking break here, and obviously you've got targets to sort of, you know, target, if you like, to the downside. Pound, I wouldn't be looking to get into a trade obviously now ahead of this data and Carney, but key levels to the upside, other than the highs that we've had of the day. You've had the breakdown of the previous low of the week that we had back on Monday, and then other previous sort of highs and lows, but probably better to sort of come on to that later on in the session. Decent trend line that I would have on if we were to push on, and this is an area that I'm also looking at, similar to Euro in it being a bit higher up, by going short around here, R1, top of this trend line as well, and using previous levels or what are currently resistance to be support levels to take a bit of profit. But probably best to come on to that later on. $1 pair, which I'm probably a bit more undecided on overall direction for now, is Aussie dollar. Technically, you've got the S1 and R1 sort of containing today's range, if you like, you would say. Levels to focus on there, and decent trend as well starting to be formed to the upside. And you're almost getting this sort of pen coming in there as well. So I'd be focusing on this if we were to see some dollar strength or weakness, and perhaps get a push out of there. And you know, you've got obvious targets of the S1 and R1 from that to be looking at. Oil this morning, we'll come on to dollar yen in a bit. Found initially some support on yesterday evening's low, and now it's getting a bit messy. We keep trying to sort of break on through, but two failed tests at the low. We could still see that break down, and then you'd be looking at the low post DOE and S1. But for now, lower volume, market quite choppy. Overall direction of this market recently, again similar with equities, it's been quite choppy, although this one perhaps you could say has been pushing higher. False sort of break that we had yesterday following the DOE of that trend, so would have given opportunities perhaps for people to get in to go long again. So I'll just bear that in mind if you suddenly now overall bias is to go short on oil. I think you probably want to see a bit more of a clean break to the downside before sort of jumping on that bandwagon, if you like. Having a look at dollar yen, decent day yesterday for the yen. Really deep, really good push down against the dollar as well that you see here. Found a bit of support this morning on what was a decent area of support on the 14th, and then the previous high on the Friday before that. So key level to the downside there. If we're looking for this market to continue going low, it might well be that from higher up is the way to go. Some levels I've marked up here, sort of previous levels of support yesterday, so it could be be acting as resistance if we were to get a push. Pivot looks quite good as well with the handle, but I think for the dollar pairs, the cleaner trades are going to come in euro and pound. Aussie dollar a bit more undecided, and as you saw yesterday, even with the dollar strength, the yen wasn't playing ball for that correlation, more focusing on what was going on elsewhere. Gold yesterday had an up and down day, literally. Pushed higher, spiked higher, sort of out its range, if you like, that it had been in, and then came back down and very quickly to find its way back to S1. So still sort of stuck within Can you see that above the camera? This range that we're in, like I said earlier, I think there's better markets to be trading at the moment than say gold and oil, where a bit choppy, and I would probably be waiting for a cleaner break either way before really looking to get stuck in. I mean, technically, yesterday's high in R1, yesterday's low in S1 for that sort of range-bound trade, but yeah, I think focus will probably be better off elsewhere. DAX, obviously with that gap lower, looking to come and fill that almost actually as we speak, so trying to push to a new high. Obviously let's mark up that gap that you can see there. Decent attempt at that for now, and Eurostox has already completed that with the pivot sort of acting as a bit of resistance for now, but obviously if the DAX was to push on, you could envisage Eurostox doing the same. Equities in the US, obviously we've had a look at S&P, so let's have a quick look over at the Nasdaq, which is just pushing on here, and quite a key level it had broken through, or key area if you like. Let me just get the rectangle up. These previous highs of the weeks, last couple of weeks, just trying to get a push on through there. So just bear in mind, you know, where we are for the Nasdaq, and obviously the key level I think you would want to see broken maybe this week for a continuation of equities pushing higher over the last few would be this one that we had back on the 14th, that Monday before. Dow Jones lagging a bit more behind yesterday's high of the evening, not too far away as well. Any questions, obviously please do let them know. We've got Carney speaking shortly, and then the pound data to come out, but if not, I'll catch you all in the chat throughout the day. Have a good one.